Hi, welcome to Entity Typology, Inventory, and Cost of Goods Sold. Let's get the show on the road here. Okay, so in terms of stuff sold, it's interesting to organize firms typologically by answering this kind of question. What's a key difference between real estate advisors and HCP on the one hand and Apple on the other hand? And the answer is clearly that Apple sells computers, phones, primarily. They sell other things, but really they're all tangible products, except of course their music service, etc., which I'm ignoring for right now. So real estate advisors does real estate consulting, and we characterize that as a service, and HCP sells the right to use a space. We also characterize that as a service. And in general, we organize firms in accounting typologically in this way. We say that a firm that primarily gets its revenue from selling tangible goods is called an industrial company. And this has nothing to do with how big the company is, how big the stuff they're selling is, etc. So for example, Apple would be considered industrial in this categorization scheme. So would GM, but so would a lemonade stand. A lemonade stand is selling that tangible good lemonade. So next up, we'd say any firm that primarily gets their revenue from fees for services is called either a consulting firm or a service firm, and that's going to include firms like real estate advisors, architects, and HCP. And again, we'll call these firms either consulting firms or service firms. And then finally, firms that get most of their revenue from investment interest, dividends, or capital gains, that type of thing we call financial firms. And we organize firms in this way because the accounting for these three types of firms has some significant differences. It has some commonalities through all three, but it has some idiosyncrasies for individuals that are unique to each of these three types. Okay, so today we're going to focus on industrial entity accounting, which is going to be important for home builders like Covenant Union, D.R. Horton, etc. So far we've focused mostly on consulting or service firms. I've been fairly sneaky about that because consulting or service firms have the most simple form of accounting, and that's what I wanted to introduce, okay? But now we're going to look in detail at industrial firms. So just for example, with Apple, the key day-to-day economics for Apple would be something like buying iPhones from Foxconn, selling phones to AT&T and Best Buy at a later date. Okay, and in GAAP accounting, we treat this type of microeconomics as follows. Okay, so the purchased phone comes into Apple as an asset, okay, called inventory. So it's not expensed right away. Apple gets this asset, so there's no expense incurred when the phone is purchased. And as we know, this is very, very similar to the way we've treated purchases of property, plant, and equipment, buildings, and other things. So then when Apple sells this inventory, sells the phone, the value of that inventory asset account needs to be reduced by the cost of the phone. And this is by definition transferred at that point to cost of goods sold expense, which everyone in the world simplifies to COGS expense. Okay. Also, at this time, revenue is recorded, okay, at the sale price of the phone, And either the firm will get cash or accounts receivable or notes receivable, something like that. Okay, so now we have three important things going on here. When a firm like D.R. Horton gets an asset it's going to sell, or part of an asset it's going to sell, that comes in as inventory with no expense. And then when the firm sells the home, the phone, the car, whatever it is, the inventory is removed, and that's the cost of the inventory gets transferred to cost of goods sold. That's step A. And then step B is, of course, whenever you sell anything, you recognize the revenue, just like we did with HCP. Okay, so now let's get a little bit pedantic here and be very careful about how we define inventory. Inventory includes two things. The first is tangible items that are held for sale in the ordinary day-to-day course of business or in the process of being put together for sale in the normal course of business. That's number one, but also inventory includes labor and any other costs that are directly needed to fabricate or assemble the completed inventory products. Okay, so it's important that we remember both. Inventory is the tangible stuff itself, all the parts that go into making the final product, but it's also the labor and other costs needed to put all those parts together and make the final inventory product. Okay, so inventory is always assumed to be a current asset. We assume that we're going to sell our inventory within a year. That might not always be true, but that's our assumption. Okay, and by definition, it does not include the cost of the sales force. So any marketing, flyers, people who are part of marketing and Salesforce, they're not included in inventory, and that also is by definition. Okay. All right, so let's do a few examples. Example one, for Caterpillar Corporation, and they make things like tractors, bulldozers, etc. Is the tractor going to be in inventory for Caterpillar Corporation? Yes, because they're in the day-to-day business of making and selling tractors. For a farm, clearly no, right? For a farmer, the farmer is going to use the tractor for many years to help make money. So it will be PPE for the farmer. Okay. Let's look at another example from the home building industry. Centex is a competitor of D.R. Horton and Hovnanian. They make and sell single-family homes. So let's see which of these following things are inventory for Centex. Okay. Land to be developed in 5 years. No, they're not doing anything with the land. They're not building homes on it, not planning to sell anything on that land for 5 years. So it's not inventory yet. Not planning to build anything for it yet. Homes completed and in construction. Yes, absolutely. This is their main day-to-day business, and their completed homes are their completed inventory. The labor cost for assembling homes, yes. If you look at the picture up above here, the labor needed to take a pile of 2x6s and turn it into this is absolutely needed to make the inventory, which is the home for sale. Similarly, with the electric bill for the house under construction. That's absolutely inventory. The carpenters, the plumbers, the electricians, they all need to be able to use their power tools. They need lighting in the inside of the house here. So they're gonna need electricity to build that house. Okay. All right, so let's go over some relationships between inventory COGS and revenue. So remember, when we purchase inventory, we're adding to our inventory asset account at cost, and no expense is incurred, just similar to when we buy PPE. And then when we sell an item of inventory, we've got these two things we need to do. One is recognize the revenue, okay, and the second is reduce the value of the inventory that the firm has by the cost of this item. And how do we do that? We do that by transferring to cost of goods sold expense. Okay. Accountants would say that cost of goods sold expense is recognized or matched at the time of sale, not at the time of purchase. Also, this roll forward equation here is going to be useful to us as we go forward. So I suggest you look it over and memorize it. A roll forward is an equation about one account in accounting that describes how the account changes over a given time period. So here's how the inventory roll forward account works. It says that inventory at the end of a period, what we wind up with, is equal to what we started with at the beginning of the period, plus any purchases, including labor, electric, etc. purchases, minus cost of goods sold, minus any write-downs. So that's going to help us out sometimes when we're accounting for inventory. All right, let's jump right into a realistic example. Let's consider Container Space LLC, CS for short. What they do is they buy shipping containers and convert them into portable, habitable spaces for retail, commercial, and the housing real estate markets. You may have seen some of these things in pop-up stores in urban environments. They are also fairly popular for residences in rural areas, that sort of thing. So let's say that we're considering a short accounting period for CS in which these two things happen. They buy a container to convert for $15,000, and then sometime before they convert the container, someone walks up and they're just in love with that container, and they say they want to buy it, not convert it into anything, and they'll pay them $20,000 for it. So being not stupid business people, they'd say, hey, we can make a quick $5,000 for having done no work with this thing. Let's do it. So they agree to make the sale and make the sale. So let's see how we would record these transactions. Okay. So the first part, we know whenever an industrial firm gets inventory, okay, they say DR inventory. We're adding to the inventory account by the amount of the purchase. And in this case, they were invoiced for that container. So they'll say accounts payable 15,000. That's a liability they'll have to pay in the future. Then when they sell this unreconditioned container, as usual, they're going to have to do two things. They're going to have to recognize the revenue, and they're going to match the expense. Okay, so let's see how that is going to look. So recognizing the revenue, we have revenue here for not 15,000, right, but 20,000, and that's an increase in equity, so that's why it has a CR there. And the other side of this is they invoiced their customer for that. Okay, So that's going to be accounts receivable, and that's going to be for 20,000. And accounts receivable is, of course, an asset that will be converted to cash some fine day. Okay, so that's recognizing the revenue. Now, in terms of matching the expense, it's always good to ask the question, do they still have the inventory? No, so we got to get rid of that, otherwise it's fraud jail for them. Okay, so we're going to have to say CR inventory at what? Not at 20,000, but at the cost of the inventory. They're carrying that inventory at cost, right? Not what they sold it for. So that's 15,000, and that keeps them out of jail. Okay, and where does that go? By definition, it goes to cost of goods sold expense, and that's a reduction in equity, so that's going to be a DR. Okay, and that's going to be another 15,000. Okay, so does some of the debits equal some of the credits here? Yes, it's all looking good. So this is how inventory works from purchase through sale. Okay. All right, so we're going to look at this and some other things using what I call several event financial statements. These are just financial statements for this very small accounting period. We'll treat this as one accounting period where just two things happen, and instead of balance sheet, which we know is always cumulative, we'll look in these periods at changes in the balance sheet, so we don't have to worry about being cumulative and getting prior period balances and all that. Okay. So let's go ahead and look at the income statement for this little accounting period. So they got the revenue of 20,000, COGS expense of 15, net income of 5K. This shows how they make their money. Okay, and let's see how the balance sheet changed during this entire period. Accounts receivable went up. That was due to the sale. Okay, and the accounts payable liability went up, and that was due to the purchase. Okay, and owner's equity went up through the sale. By the amount of the sale minus the inventory purchase amount. So as you can see, assets equal liabilities plus equity, and everything's looking good for changes in the balance sheet in that period. Okay. All right, so now we have a few more concepts governing accounting. We're almost done. We need to do matching, consistency, and materiality. I want to briefly come back to conservatism and realization in light of industrial entity accounting. So we'll start there, then we'll go on to the matching concept. Okay, so the conservatism concept says that we want to describe how to write down assets and recognize revenue and expense. So the three things it says are, as appropriate, reduce the value of assets. That's going to be any asset from cost or cost minus where to market value. Okay, so this is going to imply inventory. Okay, inventory may be written down. And then the other two things we know, recognize only revenues and additions to equity that are reasonably certain, want to be conservative, And the other side of that coin is for expenses. We only want to recognize all the expenses that we do want to recognize all the expenses that are reasonably possible. Okay, so as I said up above, for inventory of industrial entities, inventory may have to be written down in some circumstances. Okay, so the realization concept talks to us about when to recognize revenue. Okay, so let's just put this in the context of industrial entities. For something like Centex, industrial company, it's going to be recognized revenue when the house title is transferred. For container space, it'll be when a container is delivered. And for real estate associates, it's going to be when work is completed and an invoice is delivered there. Okay, so that's how we are recognizing revenue for industrial versus consulting or service companies. Okay, so now the matching concept sort of goes along with the realization concept. It's talking about when to recognize expenses. Okay, so the matching concept says three things, all right? Inventory costs associated with revenues of a given period are expensed when the revenue is declared. That's what we've been doing with container space. Okay, when they sell the container, that's when they recognize the expense. So first you determine the revenue, then you match the expense, which is the inventory costs. Okay, the second thing it says, the cost of long-lived assets like PPE, patents, and mineral deposits should be expensed over their useful lives. And that is something we have been doing already. Accountants, we do that with depreciation expense, and accountants would say that the costs of the PP are matched to periods in which they provide an economic benefit. Okay, and just FYI, PPE, patents, and mineral deposits respectively are expensed by what we call depreciation expense for PPE, amortization expense for patents, and depletion expense for mineral deposits like oil under the ground. Okay, so we've looked at the truck example, sort of beat that to death. For a truck with a expected 10-year useful life, we depreciate 1/10 of the truck's cost every year, and we call that depreciation expense. The third thing that we've got here from our matching concept is that other normal day-to-day business costs or declines in value of assets are expensed as soon as they are reasonably possible. Okay, this is things like HQ staff salary, inventory write-down. These are called period expenses. Okay, and so HCP had only period expenses and depreciation on PPE. And that's why I started using HCP as an example for us, because it's a little bit simpler than a company like D.R. Horton that has inventory as well. Okay, let's do a more realistic example. We're going to take a short break right now, and we'll come back and start in on this example. Okay.